Have you ever heard of infinite banking? I don't know about you, but a couple of days ago, I basically had no idea what it was. And then I had an opportunity to sit down with a guy by the name of Devin who broke it all down. And essentially, it is where you become the bank. And he actually just bought an Audi R8, which is obviously an exotic car, more than like $200,000 using this strategy. And he's actually making money owning the car. He's taught 1,100 people how to do the exact same thing, and I want to share with you a really awesome clip where I had him on my podcast. Let's go ahead and jump into it. Start from the beginning. You know, if you were just explaining infinite banking to me, and I didn't know anything about it, right, which I really don't know anything about it, then what does it look like?
So infinite banking is basically doing what banks do with your money. You're just doing it with your money.
Okay.
So think about what a bank does. You take your money and you deposit it with them, right? Mm-hmm. So they're holding on to your money they're controlling it basically. Yep. They have control of your money. In order for them to do that, what do they have to do? They have
Lend it out.
They have to pay you interest.
Oh, yeah. Mm-hmm.
Or why would you put your money there?
Of course, yeah.
Right?
Mm-hmm.
So they pay you a small amount of interest to control your money, and then they lend it out.
Yep.
Right? So let's say they lend it at 6%. And to keep math easy, let's say they pay you 1%. Mm-hmm. How much are they making?
5 in that scenario, yeah.
No. They're not using their money. They're paying you 1, they're turning it into 6.
Mm.
That's like a 500% return.
Right, of course, yep.
Right?
Yep. Mm-hmm.
So really infinite banking is just doing that same thing with your money. So you put it, instead of in the bank, you put it into a place where you control it, and then you borrow against it. So let's say I put $100,000 in, and I borrow against that money. That means that $100,000 is still going to compound and grow tax-free.
Yep.
Then I borrow against it, and I go do a real estate deal where I make 50% return, let's say.
Sure.
So I make 50%. I was still compounding and growing where I placed the money first.
The 100.
Yep.
Yep.
So I'm making money in two places. Let's say it's 5% plus 50. That's 55%.
Yep.
And I had to borrow against it, so it cost me 5% to do it. Mm-hmm. So I turned 5 into 55.
Sure.
Same thing the bank does.
Yep.
You're just keeping the spread, and you're making those big returns by just using your money the same way they do.
So, but why doesn't everybody do this? I mean,
people don't know about it.
Right. So, like, so now, like, logistically, like, walk me through, okay, where do you put the $100,000? Like, where at, like, what specifically does it look like?
So it's got to be a place that's secure, right? Think about why people put money in the bank is because they think it's secure. It's backed by the FDIC, right?
Yep, up to $250,000, whatever, right? Yep.
Right. So it's got to be a secure place. You have to have access to it immediately, just like the bank. Where you place it, I don't even like saying this usually because as soon as I say it, people are like, it's a scam.
Yeah.
It's life insurance.
Okay.
Life insurance companies, if you do your research, they're the most stable companies in the nation. Even more so than banks.
Yep.
They don't get bailed out when things go bad like banks do. They have billions upon billions upon billions of dollars that they lend out and that they invest to make small returns. They don't shoot for the moon, but
they're very conservative.
Super conservative.
Yep.
So they're always profitable, even through bad economies like Great Depression, World War I, World War II. These companies are still profitable, meaning if you own a policy with them, you share on the profits with dividends. Mm-hmm. So you get guaranteed growth plus dividends. It's the safest place you can put money, guaranteed to grow, tax-free. You can get it anytime you want by taking a policy loan, and it's protected against lawsuits and judgments. So if you put money in the bank, someone sues you, they could take it. If it's in a policy, they can't touch it.
Interesting.
So you put the money there. It's guaranteed to grow.
Yep.
Even while you're using it. So all you do is you just treat your money like the bank does. Put it in the policy, borrow against it, and then go make more money with it.
So how does it work? Like what life insurance? Like you let's say I tell you right now, like, hey, I got $100,000, right? And I want to go do that. Okay, I want to go do what you're talking about, right? What do I do? Just call them up? I mean, like, you know what I mean? Like, what is it? Like, what does it look? And then when I go to borrow against it, how does that work?
So here's the problem why I think most people don't know about this.
Okay.
Is these policies don't pay a lot of commission. So the companies don't have an incentive to train their agents on how to structure them like this. Because think about it. If you owned a company, which you do,
Yep.
would you train your employees how to make less money?
No, you'd train them how to make more money.
Yeah, because you want them to stay.
Yeah.
If they're making less, they're like, I'm going to go somewhere else.
Sure.
So companies don't teach their agents how to structure this. If the agent knows how, they don't want to because they want the highest commission.
Sure.
So the agent has to know how to do it. And basically what it is, it's just building it backwards. If you go in and get a regular policy, it's built for the death benefit. And the death benefit is where all the costs are. And that's how the agent makes all the commission.
Okay.
So if you get a policy like this, it's just you're building it for the cash value and you're doing a small death benefit. You're just overfunding the death benefit to get cash value.
Interesting.
So your fees, your costs are low. Agent makes less commission. You have access to your money. And all you do is when you need a loan from it, you either call the company, the insurance company, or you just go online and say, I want X amount of dollars. I want it to go to this bank account, hit a few buttons, boom.
Got it.
Super easy.
And can you borrow when you were saying a little while ago, like you borrowing against that money, right? Like, can you borrow more money than you actually put in the policy?
Once your growth outweighs the cost.
Explain that.
So let's say you put in $100,000.
Okay.
Your cost, the death benefit, is probably going to be about 20 to 30% of that amount.
It's 20 to 30 grand to keep it simple.
Right.
Okay.
So that, let's say 25 grand. You put in 25 grand, you've got access to, let's say 75. You go take it, you go make more money with it. Next year you put another 100. You got 25 that goes to the cost, but you were growing that whole time. Usually by about year 4, your growth is higher than your cost. So when you put in 100, you have access to more than 100.
Got it.
And since it never stops compounding, compound growth takes a while. It doesn't do much, but then it goes up like crazy. So I've got policies where year 10, I put in 150,000. I can take out, borrow like 250,000.
Right.
And then next year I can do more. Next year, more. Next year, more.
Interesting.
It never goes down. It always goes up.
And so then you lend that money out now, like what you're doing right now, right? Is you lend that money out to, let's say a guy like me, just to keep it simple. Let's say I'm like, hey, Devin, I want to go fix up a property, right? And I want to go buy a fixer-upper, right? Mm-hmm. I can either go to a hard money lender, right? Or I could go to you in this scenario, right? And you would loan me the money to go do that. Is that what you're doing right now?
Right.
Okay, interesting. And then so you become like the hard money lender in that scenario.
Yep.
Right?
But the thing is, I'm just not using my money.
Right,
I'm using the insurance company's money.
Right.
My money's sitting in my policy, growing and compounding tax-free. So like, let's say you wanted to borrow 100 grand. 100 grand is compounding in my policy, let's say at 5%. So I'm going to make $5,000 on that money, tax-free. And then I give you 100 from borrowing from the insurance company. And let's say you pay me 12%. So that'd be 12 grand if it took you a year.
Yep.
Right? So I make 17 grand, but I only had to borrow at 5. So it took me $5,000 of borrowed money, paying the insurance company interest, to make 17. So I turned 5 into 17, which is 320% return.
Yeah.
But most people would think I only made 12.
Right.
Right?
100%.
It's just where you put the money first. That's it.
It's where you put the money first, and then it's just understanding it, right? It's just understanding the actual return there, right? And knowing what you made. And then really you could do that on a bigger scale as time goes along, right?
Yeah, because you have more money.
Because you have more money, yeah.
The more you put towards it, the more you can do with it. So, for instance, I just bought a $206,000 supercar from my policy. So I've got this money in the policy. It never stops growing. I borrowed 206 grand out of it. So 206 grand just keeps growing.
Yep.
I go pay for the car cash. So I own the car now. It's mine.
Yep.
But if I would have bought the car from a bank, I'd have to pay them payments with interest.
Right.
Right? So I just figured out what the bank would have charged me. I just pay myself that back into my policy. So the money I would have gladly given to the bank to have this car, I'm just paying to myself over a 6-year period, just like I would have paid them.
Sure.
So I'm paying myself over 6 years about $40,000 in interest, plus the 206.
Yep.
But the whole time, the 206 never stopped compounding.
It's still compounding, yeah.
So I actually make about 70 grand just by buying the car.
Right, for sure. Yeah, it makes all the sense in the world. Yeah, I wonder why more people don't know about it. Like, where do people learn? Where did you learn all of that?
Do you know who Steve Trang is?
Uh-huh.
So COVID hit March of 2020, and I was getting all my deals from going to meetups.
Okay.
Local meetups, just meeting people and letting them know I do flips and I've got some capital. Like, I'd love to look at the deals. People would send me deals, and I'd send them to temp, figure out if they're a good deal, and then we'd go in and JV the deal. Meetups went away.
Right.
There was no meetups anymore, so I'm like, what am I going to do? So I'm just listening to podcasts. I'm listening to Steve Trang's podcast, and this dude named Chris Noggle was on the podcast talking about becoming the bank. And I'm like, that makes a lot of sense. So I went down the rabbit hole, like reading books, listening to YouTube, and eventually I'm just like, I heard from this guy, Chris. I should get on the phone with this guy, Chris, and figure out what it is.
Right.
So I scheduled a call with him, and I got my first policy May of 2020. Started using it. I was like, it's incredible.
Yep.
So then got 3 more policies that year, started telling everybody about it, got on social media, started talking about it, and everyone's like, dude, this is incredible. How do I do it?
Yeah.
I'm like, well, just go to this guy, Chris.
Yeah.
So I was sending like 15, 20 people a day to him.
Yep.
Because my TikTok was the first thing that like blew up. I got like, within 2 months, I had like 120,000 followers.
Wow.
Everyone's asking me how to do this infinite banking. And it hits me. I'm like, if they're learning from me, shouldn't I be the guy that sets it up?
For sure.
So I hit up Chris. And I'm like, dude, how can I do what you're doing and set people up with these policies?
Yep.
So now since March of last year, I've set up 1,100 policies.
Wow.
Crazy.
That is insane.